When a massive, globally dominant company reports that their net profit just dropped by over 150 billion yen, the usual reaction is just pure panic.
Oh, absolutely. It's, red flashing lights on the trading floor, headlines predicting absolute doom. We all like our growth charts to point up and to the right in a perfectly straight line.
Right, but we know that's not reality. And today we're looking at a scenario where that exact 150 billion yen profit drop happened, and yet, well, if you actually look under the hood at the mechanics of the business, they might be stronger than ever.
Yeah, which sounds completely counterintuitive, I know. But welcome to this deep dive here on the Japan Stock Podcast. We are so glad you were joining us today.
Yeah, welcome. Today we're unpacking the incredibly complex, really sprawling ecosystem of Mitsubishi Corporation, or MC. We're going to analyze their newly minted management strategy 2027 and dissect their financial realities as of early 2026.
Basically, we're going to read between the lines of the balance sheets for you. We need to analyze the macroeconomics and those geopolitical shifts that are actively shaping Japan's premier trading house.
And before we really jump in, I do want to make a quick note. We are going to touch on some politically sensitive topics today, specifically U.S. trade policies, global tariffs, the so-called Trump effect.
Right. Hard to avoid when talking about global trade.
Exactly. But we want to be completely clear to you listening. Our discussion will remain strictly impartial. We're not taking any political sides or endorsing any viewpoints. Our only goal is to track the economic impact on MC's performance based on the source materials.
Just following the data. Because to understand why a profit drop of that magnitude isn't a death knell, we have to fundamentally redefine what MC actually is. I mean, if you just read a textbook from 20 years ago, you'd assume they're a traditional Sogo Shosha.
Just a simple trading middleman.
Exactly. Buying steel in one country, marking it up a few pennies, and selling it in another, earning this tiny, tiny margin on massive volume.
But looking at their current operations, that definition feels like a total relic. They're no longer just shipping boxes on boats. They are an intelligence-driven ecosystem operator.
Yeah.
If we break down the core drivers that generate roughly 80% of their scale, you're looking at 5 massive pillars. You have Earth environment and energy, which is anchored by liquefied natural gas, or LNG.
Right, a huge one.
Then you have mineral resources, focusing heavily on copper and metallurgical coal. Then mobility, which includes Mitsubishi Motors and Astara in Europe.
Yep.
Then the food industry, where they're actually huge players in global salmon farming.
Yep.
And finally, what they call SLC.
Which stands for Smart Life Creation. And that segment includes their massive consumer and healthcare footprint, but most notably, it's the Lawson convenience store chain in Japan.
Now, let's unpack this for a second, because looking at that list, copper mines, salmon farms, convenience stores, it feels totally disconnected.
It does. It sounds like a random grab bag.
Yeah.
But to give you a visualization of what this actually is, they're basically the ultimate global toll booth crossed with a venture capital fund.
I like that analogy.
Right, because they own the road, they own the trucks driving on that road, and they own the retail stores those trucks are delivering to. Think about the last time you bought like an onigiri at a Lawson. You just saw a quick transaction for lunch.
But MC's underlying system just saw a data point.
Exactly, a data point that connects all the way back to their global food and logistics supply chains. They don't just hold minority shares in these ventures as passive investors hoping for a nice dividend. They actively operate them.
And they run this highly complex portfolio of real physical assets, leveraging proprietary global data to predict supply chain bottlenecks before they even happen.
Which is incredible. But getting to this level of operational efficiency, it required going through a rather brutal drama of adaptation.
Yeah, they didn't just wake up as a perfectly optimized machine. They had to take some hits. Historically, MC, well, like all trading houses, was deeply vulnerable to the boom and bust cycles of the commodity supercycle.
Oh yeah, when global oil or coal prices crashed, their balance sheet just bled out.
Right. But they've actively used those historical scars to build their modern armor. They've systematically shed underperforming or highly volatile assets to transition toward predictable, integrated value creation.
So give me the mechanics of how that practically works. Like, for the listener, how does a massive corporation turn a scar into armor?
Well, by making really hard choices to protect the core. For instance, in 2024, they sold off their stake in KFC Holdings.
Oh, wow.
Yeah, they looked at the fast food landscape, saw the margin compression, and just decided it wasn't a core operational fit anymore. And on the resources side, they actively consolidated their metallurgical coal operations.
And we should probably clarify, metallurgical coal is used for making steel.
Right.
not burning for electricity.
Exactly. It's a high-margin asset essential for global infrastructure. But rather than holding a dozen mediocre mines, they sold off the bottom tier to focus exclusively on top-tier, highly efficient assets.
So they're actively walking away from volatile, low-margin operations.
Yes, which brings us to their recent financial materials, specifically looking at early 2026.
Right, the elephant in the room, the big profit drop. Let me push back on this for a second. If I'm a retail investor looking at my portfolio, profit is the ultimate scoreboard, right?
Sure, on the surface.
MC's net profit dropped from 950.7 billion yen in fiscal year 2024 down to 800.5 billion yen in fiscal year 2025, which just wrapped up in March 2026. You can't tell me that some new internal strategy completely makes up for a drop that massive.
I hear you. But let's look at the balance sheet on that, because accounting profit can actually be a dangerous illusion.
An illusion? How so?
Net profit includes a lot of paper gains and losses. It includes asset revaluations, currency translation adjustments, or one-time write-offs. That 150 billion yen drop looks terrifying on a headline, sure.
Yeah, it does.
But MC's new management strategy 2027 explicitly shifts their primary management metric away from pure net profit. They are now relentlessly focused on operating cash flow.
Because you can't fake cash.
Exactly. You cannot fake cash. Operating cash flow proves the actual physical cash-generating power of the day-to-day business.
Right. Are the convenience stores actually making money? Are the copper mines generating actual dollars?
Exactly. And under their new strategy, their three pillars are enhance, reshape, and create. They are targeting an average growth rate of over 10% for operating cash flow and aiming for a return on equity, or ROE, of over 12% by 2027.
So what does this mean for us? Why should retail investors care about operating cash flow more than the bottom line net profit?
Because OCF is the actual lifeblood. It's the cash they can physically hand back to you as a shareholder, regardless of what the paper valuation of a coal mine does on a given Tuesday.
Oh, I see.
And they use that cash to fund progressive dividends and flexible share buybacks, which is the direct mechanism they use to keep their net debt to equity ratio safely below 0.6 times.
Okay, let me just ground that metric for a second for everyone listening. Keeping the net debt to equity ratio below 0.6, think of that like having a $600,000 mortgage on a house you own free and clear that's worth $1 million.
That's a great way to put it.
It means you have massive wiggle room if the economy crashes, rather than being choked to death by interest payments. It is literally a fortress of financial stability.
And we saw exactly why that fortress was absolutely necessary when we look at the incredible macro volatility of March 2026.
Oh yeah, March was wild.
Driven by escalating tensions in the Middle East, we saw Brent crude soar past $110 a barrel. Simultaneously, JKM LNG spot prices, the benchmark for Asian natural gas, spiked over $20 per MMBtu.
And for anyone not actively trading energy commodities, an MMBtu is a million British thermal units. It is essentially the amount of energy you'd need to heat a typical home for a few days in the dead of winter.
Right.
So $20 per MMBtu is a massive, aggressive spike. If you're holding energy assets, you're popping champagne.
On the surface, you are. But let's trace the causal chain here, because this perfectly illustrates their internal hedging.
Okay.
That energy spike immediately inflates the earnings per share, or EPS, of MC's Earth Environment and Energy segment. They capture a massive windfall.
Right. The energy side wins.
However, in the real economy, $110 oil instantly increases logistics, transportation, and input costs for their Smart Life Creation segment.
Meaning the loss in stores.
Exactly, and their food segment. The cost of the diesel required to move that salmon and stock those convenience store shelves just skyrocket.
Ah, see the mechanism now. It acts as an internal financial shock absorber. When the energy arm wins big due to a macro shock, the retail and food arms bleed because of immediate inflation.
Precisely.
But flip that around. When energy prices crash, inflation cools, logistics get significantly cheaper, and the retail arm prints money.
Yeah.
Either way, the overall corporate ROE remains insulated from the wild swings of the global economy.
Which brings us to their true competitive moat. I mean, a hedge fund in New York has access to billions in capital, but they cannot replicate MC's hands-on operational intelligence.
Right, they don't own the physical assets.
Exactly. MC operates a logistics network of 7,600 trucks daily just for food distribution in Japan. And they don't just run those trucks blindly. They integrate that physical network with AI demand forecasting.
Meaning they are tracking weather patterns and local event schedules to adjust delivery routes in real time. like predicting exactly how many umbrellas or iced coffees a specific Lawson will need on a Tuesday afternoon.
Yeah, and that saves millions in wasted inventory and fuel. They don't just trade the spreadsheet, they actually drive the trucks.
But this internal shock absorber only works if you can anticipate where the next macro shock is coming from. And right now, the biggest shock waves testing this balance are radiating out of China.
Yeah, let's talk about China. The narrative for the last 2 decades in global business was, expand into China at all costs.
Right, you had to be there.
But MC's recent data shows a major strategic pivot. Far from being dangerously overexposed to the Chinese real estate slump, MC has actively managed its gross risk money in China down to 147.1 billion yen.
Which, honestly, in the context of a globally sprawling balance sheet, that is a remarkably tightly controlled exposure.
It really is. But here is the stunning data point that jumped out of the early 2026 reports. Mitsubishi Motors sales in China and Russia have effectively dropped to zero.
Wait, really? Zero?
Zero.
I have to challenge this. Zero sales in the world's biggest auto market. How is that not a catastrophic failure of strategy? Like, if I'm looking at this, it seems like a disaster.
If you view it without the underlying mechanics, sure, it looks like a total defeat. But let's look at the causal chain of the Chinese auto market right now.
Okay, let's break it down.
The Chinese EV sector has become hyper-competitive. It's driven by massive domestic subsidies for local brands and structurally disadvantageous conditions for foreign automakers.
So we are talking about a brutal price war. Domestic brands are slashing prices below the cost of production just to gain market share.
Exactly. So MC realized they could not win that price war without completely destroying their own profit margins.
So they just walked away.
They did. Instead of bleeding cash to maintain like a 1% market share just for the sake of saying they operate in China, they pulled the plug. They dismantled their manufacturing joint ventures, took the one-time restructuring charge, and cleanly extricated themselves.
Wow. They stopped the bleeding, reallocated that capital, and fortified their true strongholds.
Yes, exactly.
But wait, which are where? If they aren't selling in China, where is the mobility moat?
The ASEAN nations, specifically Indonesia, Thailand, and Vietnam, and also Australia, that is where Mitsubishi Motors prints money.
Oh, because in Asian markets, the infrastructure isn't ready for a massive EV grid yet.
Precisely. If you are driving across thousands of islands in Indonesia or navigating rough, unpaved terrain in rural Thailand, an EV charging network is practically non-existent.
So MC dominates the market for rugged, reliable combustion and hybrid vehicles like their Triton pickups that actually fit the local geography.
Yeah, they essentially dodged the EV price war in China by dominating the regions where the physical infrastructure demands their specific products. They took the ego hit of leaving the world's largest market to protect their operating cash flow.
It is a textbook example of reshaping a portfolio, taking the loss up front for long-term stability.
Exactly. But moving from one geopolitical hotspot to another, the late 2025 and early 2026 financial materials explicitly cite the Trump effect as a major driver of global economic deceleration.
Right. And again, keeping our neutral lens here, we are seeing a massive shift in U.S. trade policies, specifically the looming threat of sweeping global tariffs. And looking purely at the causal chain of how these tariffs impact the balance sheet, how exposed is MC?
The impact is actually quite nuanced, mostly because of that geographic moat we just established.
Let's trade the Asian folk.
Yeah. Because MC's primary automotive manufacturing and sales strongholds are in the ASEAN region and Australia, they are largely insulated from direct U.S. tariff crosshairs.
Because they aren't trying to flood the U.S. market with passenger cars manufactured in Mexico or China.
Exactly. So their mobility profit margins are fundamentally protected, even though indirect supply chain ripples like the rising global cost of raw materials still create some friction.
So if the U.S. is essentially a tariff minefield for traditional imports like consumer autos, where is the actual upside for MC in America? Like, why even stay engaged in that market if the trade barriers are going up?
Well, the hidden gem in their 2026 strategy is U.S. data centers and power demand.
Wait, data centers? They're pivoting from cars to servers.
Yeah, let's look at the mechanics of the U.S. grid. You cannot just build a 100-megawatt data center for artificial intelligence anywhere you want. The U.S. power grid is heavily constrained.
Right, and AI requires an insane, unprecedented amount of electricity.
Exactly. And MC is aggressively leveraging its legacy North American real estate and energy generation assets, which they've held for decades, to capture this high-margin surge in electricity demand.
Okay, that is a brilliant pivot. They look at the massive energy deficit created by tech giants building out AI infrastructure,
Yeah.
and they step in as a turnkey solution provider.
Yes. They combine their real estate footprint with their energy generation expertise to power the servers.
And that completely bypasses the consumer tariff issue because they are providing localized infrastructure, not importing consumer goods.
Exactly. It is the reshape and create pillars of their 2027 strategy in real-time action. They reshape away from low-margin imports and create new value in high-margin AI infrastructure.
Now, we really can't talk about a Japanese corporation's international exposure without talking about the 800-pound gorilla in the room, the Japanese yen.
Yeah, we have to talk about the yen. The currency environment has been incredibly volatile. The yen ended fiscal year 2025 extremely weak, sitting at 159.88 yen to the US dollar.
And for a global exporter and trading house, that currency dynamic fundamentally dictates their bottom line. To put the sensitivity in perspective for you listening, historically, every single yen of depreciation against the dollar adds about 5 billion yen to MC's bottom line.
Just a 1 yen movement equals 5 billion yen in profit.
Yeah. Let me give you an analogy for how powerful that is. It's like selling your products abroad and getting paid in heavy gold coins, and then bringing those coins back to a country where everything is priced in cheap silver.
That's exactly it.
Suddenly, your buying power at home explodes without you having to manufacture or sell a single extra unit. Which is why, when the yen sits weak at 159, their foreign earnings, especially those dollar-denominated LNG contracts, repatriate into massive domestic profits. It artificially inflates their EPS.
But, as with everything, it is a double-edged sword.
Because they don't just export, they import.
Precisely the issue. A weak yen makes importing raw materials for domestic Japanese consumption much more expensive.
Right, their food division has to import salmon from Norway or wheat from the Americas into Japan, and suddenly their purchasing power is totally gutted.
But again, this loops right back to the internal shock absorber we discussed earlier. Earning massive premiums in dollars on energy exports gives them the cash buffer to manage the inflated domestic costs of stocking the Lawson convenience stores.
They balance the scale, protecting the overall ROE from wild currency swings. They have essentially engineered stability out of absolute global chaos.
They really have. So what does this all mean for you, the listener, trying to wrap your head around this behemoth? Let's synthesize this journey.
Yeah, let's bring it all together.
Mitsubishi Corporation is absolutely not a relic of 20th century trading. They aren't just sitting in a dusty office collecting a fractional toll on steel shipments. They are a highly fortified, globally diversified ecosystem.
They take their historical scars, like the commodity crashes of the past, and turn them into modern armor.
Right. They actively shift their reliance away from highly volatile commodities and pivot toward predictable cash-flowing platforms.
Whether it is optimizing Lawson convenience stores, dominating the rugged ASEAN mobility market, or powering the next generation of U.S. data centers, they're transitioning from being a traditional middleman to being a supreme global operator.
They dropped 150 billion yen in net profit, and they didn't blink, because their operating cash flow, that 0.6 net debt-to-equity fortress, remains rock solid.
Completely solid.
Which leaves us with a final, slightly provocative thought to mull over. As we've unpacked today, MC is explicitly focusing on AI to optimize absolutely everything.
Everything.
They are using AI demand forecasting for convenience store inventories. They are algorithmically routing 7,600 trucks every single day. And they are physically powering the data centers that house AI in the U.S.
Which means their access to real-time global supply chain data is practically unrivaled by any pure financial institution out there.
And that is the question to take away with you today. With all this physical infrastructure feeding them real-time data from every corner of the globe, their ultimate asset in the 2030s won't be copper, and it won't be natural gas.
No, it'll be their data.
It will be their proprietary global data set. If data is the new oil, are traditional trading houses quietly becoming the most powerful predictive AI engines in global finance?
It really raises a vital question about how we value these companies moving forward. I mean, the physical assets, the trucks, the stores, the ships, they might just be the sensors collecting the data.
Something to keep in mind the next time you look at a supposedly boring balance sheet.
Absolutely.
Thank you so much for joining us on this deep dive. As always, keep questioning the narrative and keep questioning the data. We'll see you next time on the Japan Stock Podcast.